Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So there are a few companies that are still on my watch list, and I'm going to talk about one of the companies that I do not own yet, and it has been on my watch list for a very long time. I want to see if this company is a buy right now, if I should wait a bit longer. I'm going to give you a little bit of information about the company. We'll look at the fundamentals of the business, we'll look at the valuations, and then we'll compare that with the rest of the markets, similar sort of a sector, as well as of course the S&P 500. Now, it takes a lot of time and effort to put these videos together. I would genuinely appreciate if you can just press the like button right now. That will cost you absolutely nothing. If you have not subscribed, please subscribe to the channel. There's about over 50% of you guys that watch the videos regularly that are not subscribed, so please do help the channel as much as you can. By helping the channel, you're helping other ummah. So there's so many brothers and sisters out there who have absolutely no idea or maybe confused about investing in the stock market. And what we're trying to do basically is help as much as as much brothers and sisters as we possibly can, inshallah. That's the long goal. So inshallah, hopefully you can do that for me. If you can also, it will be absolutely amazing to have you on the Discord. I'll put the Patreon account where you get access to the Discord. You see all the buys and sells from the family portfolio, from this portfolio, the dividend trackers, the calendars, the watch lists, the 10 high quality businesses that I normally share, and loads of other little things that I regularly share with the community, and that will be really helpful. And if you can join us, it will cost you about 15p per day, and it really helps the channel, as I said. Right, let's talk about this company. The company that we're going to talk about today is TJK Maxx, which is basically, for us, I say TJ Maxx because that's the company that we know in the UK, but the name of the company is the TJX companies, okay, if I can say the word. And this company is a retailer, and as we know, these are the brands that they own, and the only one I know is TK Maxx in the UK. TJ Maxx is also in the US. I'm not sure if HomeSense, I feel like I've seen HomeSense in the UK. I'm not sure if it is, but the rest of them, I don't think I've seen them. Home Goods looks familiar, but they do own quite a few other brands, and they are of course retailers, and they've got loads of different types of products and so on. So you can go to their website and have a look at what they do and so on. But what I want to do now is just to kind of give you the financials of the business, and then we'll take it from there, inshallah. Now, in terms of the year-to-date performance, it's done absolutely amazing, 26%. This is a consumer discretionary company, and it is actually really outperforming the S&P 500, which is absolutely crazy. It's been on my watch list for about now a year and a half. I've not seen it cheap at all. So let's see what happens today. So about 20% in the last 6 months. Just for this month is up 4.4%. They've reported the earnings recently. They beat both top line and bottom line here. Everything seems to be going in the right direction. Their forecasts are absolutely fine, nothing to worry about. And basically, in terms of the pre-tax profit margin, basically they're expecting about 11.8 to 11.9, and when it comes to EPS, they're expecting $1.06 to $1.08. So that's probably what was expected from analysts and so on, because the stock, when that happened on the day, it was actually fine. I think it was trading slightly high. I can't remember exactly what happened. But yeah, from financial perspective, in terms of what they've reported recently, it seems absolutely fine. And the couple of things I want to look at now is just look at the revenue. Okay, so we've got $29 billion in 2015, 30, 33, 35, 38, 41. Then it came back down basically in 2021 because of COVID. Okay, so that year was basically the year February, and that's when they reported. The year after, February 2021, basically, of course, that massive hit from COVID. But the year after that, 28, so they've actually moved up from where they were, about almost over $7 billion. And then the following year, about 49.9, let's call it about 50, 54, 55.6. So it's really heading in the right direction, apart from that 1 year COVID side of things. But of course, these companies, they spend a lot of money to make that money. Basically, the cost of the revenue is always quite high for these type of businesses, but they still has basically gross profit. So from the 55 billion, they spend 35. they've taken home basically gross profit of $20.3 billion. They've research and development, all the sales, advertisement, all the taxes. After they've done all of those things, they have basically what they've left with is $4.7 billion of basically net income, which then can be translated into some sort of a free cash flow. Now, if we look at the basic EPS as well, from $1.06, okay, to every single year basically increasing, apart from 2021, basically the year of COVID, when they reported, and then it went back again, 2.7, $3, $3.90, and right now $4.19, which is absolutely fine. So when you look at the business from, it's profitable business, things are growing, things are heading in the right direction. So what we want to now see is if this company is the rest of the financials of this business. If you haven't pressed that like button, please do so. Like I said, it really helps the channel. Right now, the stock is trading $117 per share, EPS of $4.14, market cap of $133 billion. So it's a huge company. It has a wide economic moat. Current beta is below 1, which is nice. And this is one of the reasons why I like this type of businesses. They're profitable. They're making money every single year. They've got dividends. They've got excellent free cash flow and so on. And then, of course, their beta is quite low. This is, for me, is what I like to call foundational stocks. But this business is very cyclical because remember, it's consumer discretionary, meaning basically when recessions and things like that happen, these companies do not perform as well because the stuff that they sell are not essential to to customers, if you like. Okay, current PE is about 28, 77 when it comes to the forward PE, which is crazy, and the 5-year. That's crazy. Let me just double check that. Let's go to valuations and the forward PE for this business. Sorry, here we go, 28. So that's wrong. This is wrong. Okay, so this is wrong. That shouldn't be that. Yeah, I knew that didn't make any sense. So the current P is 28 and the forward P is about 28. The 5-year average is about 14 and the price to free cash flow, we're looking about 30. Now, in terms of annual dividend yield, we're looking about 1.2, which is not huge, okay, for this type of business, but $1.42 is what you get. The payout ratio is very low, and I like the fact that they've got double-digit growth when it comes to the latest increase and the last 5 years. So despite this being basically very low, I like the fact that they're growing that dividend, and they have only increased this dividend for the last 3 years only. They've got 80% safety, which is absolutely fine. $4.54 billion. We've already seen 4.7, I think, whatever it was, in terms of the net income. But look at that. Basically, a lot of it translates into free cash flow here. Free cash flow compound annual growth rate for the last 5 years, we're looking about 14%, which is absolutely huge. Free cash flow yield of 3% and free cash flow margin about 8%, which is nothing to worry about. I mean, it is fine. Basically, for this one is actually good, but 3%, that's absolutely fine. We're looking for 3% or more. Now, profit margin about 9%, operating margins about 11%, and the return on equity about 66%. Return on invested capital about 30%, which is absolutely fine. So I like that. That's absolutely fine. And the net income for the compound annual growth rate for the last 5 years, we're looking at about 9%. Total return the last 10 years, about 15%, over 15%, which is really, really good for this type of business. Revenue growth for the last 5 years, 7%. When it comes to EPS, about 9%, which is good. Current ratio is above 1, which covers the current liabilities in the next 12 months. They expected the earnings to grow about 10%, then 9% every year for the next 5 years. We've already seen the price, $117 per share. Morningstar is saying it's $81 per share. So they think 46% premium right now. According to Simply Wall Street, it is actually flat. So they saying it is a buy right now, according to them. So that's basically their price is $117 per share and 92. So look at that, 93. There's not much of a difference. Target price from tip rank is actually 131. That's about 12% upside from where we are, and it's also a strong buy from them. Target price from Seeking Alpha is 126, about 7% upside from where we are. Seeking Alpha is basically saying is also a buy right now. So these guys are okay. I kind of do agree with these guys here, but we'll combine all of these things and we'll see basically what we get in terms of valuations. When it comes to Sharia compliance side of things, I like this company. It doesn't have a lot of debt, which is quite nice. They're buying back their own shares, which is really good. So you're getting your 1% dividend yield. You're getting also buybacks, which means, okay, one share of this company that you own initially is now worth more, but after if you had it for the last 10 years, basically. Now looking at the valuation side of things. we've seen Morningstar 81, we've seen Seek and Alpha 126, Simply Wall Street $117 per share. I used the discounted cash flow model and that gave me 126 and 95. Multiple valuation I used to also give me $104 per share. Now according basically to, if you average all of that out, you get $109 per share. Is right now 117. That's 7% up, basically downside from where we are right now. Now you might still want to say, you know what, this is not a very high risk company, so I'm going to give myself margin of safety of another 5%. So that means you're basically going to wait until it hits $104 per share, which is closer to the average intrinsic value that we've got here. Okay, so if you wait for that, maybe it's been just below $105, 100 whatever shares, then maybe that will be a good entry point, and I probably will do the same. So I probably will wait 105 or below. If the markets basically come down, it's not far off. Okay, I've seen this company trade, so it's not far off from there. It would be even better if it goes below 100, because then at least, like I've always said to you guys, Morningstar, I feel like they give you a little bit of a margin of safety in comparison to other companies. For example, Simply Wall Street, as they just use similar sort of evaluation, so discounted cash flow model, which is what I used here, but at the same time they slightly lower. Slightly basically low, always lower than their when it comes to their predictions. Now a couple of more things. Now, comparing it with a couple of the companies in the same sort of a sector, so Gap and so on, and right now, this is the company here. This is the S&P 500. That's the most important one. So as you can see, 31% basically for the 1 year, 29, so not far off. And then the rest of them has done slightly better. This one is Gap has done absolutely amazing for this 1 year, which is interesting. Now, for the last 3 years, we're looking about 78%, S&P 500 only 30%. So they did beat the S&P 500, which is absolutely amazing. And the rest of them have done, yeah, okay. Look at Gap again. Now, for the last 3 years, they actually down. Now, for the last 5 years, 129%, 90% for the S&P 500. So that's another beat. And these companies have done relatively okay. For the last 10 years, 352. S&P 500 187. So when you look at this company, they have beaten the S&P 500 over the last 10 years, which is absolutely amazing to see from a company that basically is consumer discretionary and so on. So there you have it. That's the company that I wanted to share with you guys today. If you're enjoying this type of content, please join us on the journey by, of course, liking the video, subscribing to the channel, and of course, join us on the Patreon account where you get access to a lot of these things, inshallah, and it really helps the channel massively. Anyway, that's what I wanted to share with you guys today. I hope we have a good week when it comes to the trading week, and we'll see what happens. I think the market is open right now as we record. Basically the UK companies are just starting. But yeah, I'll let you guys know. I've got I'll be buying a few more shares this week, £260. As soon as I buy whatever, I will be sharing it here, and I'll let you know, inshallah. Have a wonderful day. Assalamu Alaikum.